And we'll talk more about some of the things that they do to ensure that when we talk about independence. Basically, with generally accepted auditing standards, remember the standards are geared toward the fact that auditors are expressing an opinion on the financial statements, right? And they're expressing that opinion that basically says that they're obtaining reasonable assurance, right? And why do you think it's reasonable assurance? We talked about this a little last week. Why, again, is it just reasonable assurance as opposed to absolute assurance? What do you think? Yes, Victoria. Exactly. Jimmy?
In addition to that, it's not the auditor's job to actually create the financial statement.
Right. The auditors don't create the financial statements. They're testing on a sample basis. Ricardo?
Financial statement and all that, there's certain accounting assumptions taken into consideration.
Right, exactly. Extremely good point, right? You're taking their assumptions in the financial statements, right? Because we know that there are estimates in the financial statements. So management's making some estimates about that. So they can only provide reasonable assurance about the statements, the financial statements. What they're providing reasonable assurance about is that they're free of material misstatement. So when we talk about materiality, we'll visit this topic of material. What does that mean? But on the face of it, what does it mean to you? If you had to phantom a guess, what does it mean?
So does
Ella?
it actually affect the way all the people will see the report?
Exactly, right? So and that's a very good definition of materiality. Is how would this affect? Would this affect the decision of a user, a reasonable, knowledgeable user of the financial statements? And that's basically the concept of materiality. Now, there are ways to calculate it, but that's the overall concept. Yes, Ricardo?
Is there a certain threshold that auditors take into consideration?
Right.
Is there a certain type of testings?
Right.
There's a certain threshold they go by?
Mm-hmm. Right. And we'll talk about that more, but yes. So the auditors have to decide. So to be able to decide whether you don't know what's going to affect, right? Because we all have different thresholds in terms of what we consider material. You know, some of us, if we lose $100, that's a lot of money to us. Other people, it might be, oh gosh, like dropping a dime, right? So it's not that important. So when you have this universe of people who are relying on the financial statements or using the financial statements to make investment decisions or lending decisions, you couldn't possibly, as an auditor, know what's going to affect each and every person individually. So as Ricardo pointed out, auditors use guidelines to determine materiality, right? They use thresholds, and I won't get into those yet because we'll talk about those in a couple of weeks. But they're guidelines that they use to determine what is material, okay? And we'll talk about that next week, in a couple of weeks. And basically, the generally accepted accounting principles, again, are geared to, I'm sorry, not accounting principles, generally accepted auditing standards are geared toward the auditor's report and the auditor's opinion. So the process of the audit, of collecting evidence, right, and evaluating that evidence with the objective of issuing an opinion or providing an opinion on the company's financial statements, because that audit report is